It's for me a pleasure to chair Jacques' DREZE lectures. And these lectures will be followed by a discussion, as you know, to which will participate Christian Gaulier, Jean-Jacques Herings, and Martin Helwig, and you as well. So that will be tomorrow. I guess that you all know very well Jacques DREZE. There is no need to introduce him. In particular, you know that uncertainty is the key theme of his research over the last 60 years or so, maybe more. Before giving the floor to Jacques, let me say a few words. The first lecture will appear, I'm afraid, to some of you as rather technical. You will agree. Jacques will indeed start with a number of results that will be used in the next 2 lectures. So please, don't be discouraged by the first lecture. I can tell you that what follows is worth waiting. By on his own contribution to the implication of market incompleteness, Jacques will identify possible remedies to the present recession, together with a number of research challenges that he hopes that the young generation will take on. During the lectures, Jacques will welcome clarification questions only. So I suggest that indeed that you wait until the discussion tomorrow to raise questions of substance. So Jacques, floor is yours.
Thank you, Pierre, and thank you also for all the work in organizing these lectures. I must say that for me, looking at this audience is an immense joy and privilege. So many colleagues, number of former students, but mostly friends. Thank you for being here today. It is really a pleasure for me to share with you some of my thoughts at the time of retiring. These lectures will be concerned with the design of economic policies under uncertainty and incomplete markets. One originality is that I will work under incomplete preferences and explain in a minute why. And incomplete markets and incomplete preferences result in economic models that, at least at the theoretical level, but also empirical, are more intricate and more difficult. So, as you would expect, it will also be incomplete results. And because the results are incomplete, I make an effort to invite you to follow up on a number of problems. As the title suggests, I will start from a general equilibrium viewpoint, but with a definite intention to integrate micro and macro reasoning. And in the second lecture today, there is a theorem which I think provides a useful link between the two. In general equilibrium theory, uncertainty is treated in a very abstract manner. The key reference is DREZE chapter 7. Uncertainty comes in through exogenous events, which, as they develop over time, form a tree. In principle, the tree should be infinite, but there are end nodes which are in fact the starting point of subtrees thereafter. examples I suggest of these exogenous events would come from climate, from politics, from agricultural production, research, etc. The Chapter 7 model assumes that over this future, all the economic activities are coordinated at time zero through markets. Markets for contingent delivery of commodities given a certain event at a future date, or ultimately a state at the end of the tree. This is an abstraction. It proved so far useful, and I hope to make it even more useful, but as such, it is an abstraction. If you try to give concrete examples, you would ask, how could a first-year MBA student contract today for her entire future career, conceivably on all relevant circumstances, be they professional or private life or whatnot? It's a pure abstraction. So the only reasonable approach is to recognize that this full set of market does not exist. And the examples also suggest that preferences are incomplete, that nobody would express well-defined preferences over the full tree and all the commodities there. If we think instead about uncertainty from a practical, empirical viewpoint, yes, here are some recent examples. If I went over my lifetime, I should start with 1929, but nobody else in the room would follow me. So let us talk about more recent occurrences. In the 60s, European and North American economies were operating at basically competitive equilibria with moderate but constant growth. These have been referred to as the golden 60s, but it came to an end with the first oil shock, which was basically an economic event, but with a timing largely political and unforeseen. And this has led for several years to fluctuating levels of unemployment, but much higher than during the golden 60s. An interesting event is the Gulf War of '91, which led immediately to a sharp decline in investment. But the decline lasted only 6 months. So it's completely different from the consequences of the oil shock or of the recession that started in 2008 and that is still with us and will remain with us who knows for how long. I could have added as a fourth example Brexit. Today, Brexit is a major source of uncertainty, especially for British firms, but for all those who deal with Britain. And there is today a fair amount of uncertainty about the exact content that Brexit will take and when this will occur, and this has clear implications today for investment in particular. I'll come back to that in the third lecture. But to start with, I would like to discuss with you some very simple, concrete uncertainty situations coming from insurance, reinsurance, and income taxation. And one major motivation for going over these reasonably well-known situations is that they illustrate the limits of our ability to cope with uncertainty situations with the degree of efficiency that theoreticians suggest. So, let us, as I had announced, start with general equilibrium. And I remind most of you who did take a course in general equilibrium with me here? A minority, okay. So the general equilibrium model starts with economic agents, households and firms, commodities which are produced and exchanged, including labor services. I have already mentioned the event 3, and households are identified with an endowment of commodities over the 3, a consumption set indicating what consumptions are feasible for the agents, an important element of which is the needs for survival. Being inside the consumption set means being able to survive, although there may be accidents. But if you were somehow taken outside, that means you would not be surviving. Now, I introduce at once the preference relation, PH of X, in the consumption set, which consists of consumption plans recognized by the agent as preferred to a certain reference X. In a moment, we will see how to work with that relation under incomplete preferences. Of course, in the standard theory, the preferences are assumed to be complete. I come back in a minute. The firm is defined by a production set. One calls private ownership economy this model where the ownership of firms is through shares of stock, and one talks about a pure exchange economy if production and shares are given. Physical feasibility requires that for each consumer, the consumption vector should belong to the consumption set. For each firm, the production should belong to the production set, and the markets should clear in the sense of supply equals demand. Very often one assumes free disposal, in which case there is an inequality, but that's unimportant. Now, introducing markets, one also introduces prices, and one can then define a competitive equilibrium, and one can define the two welfare theorems relating competitive equilibria to Pareto efficiency. To that end, we must first introduce the budget constraints of the agent, who cannot spend more than they earn. In the standard DREZE model, no explicit borrowing, but that will come in a minute. So a competitive equilibrium is a physically feasible allocation such that for all consumers there does not exist a feasible alternative which is preferred. The intersection of preferred set and feasible set is empty, and the firms maximize profits. Under rather weak assumptions, a competitive equilibrium exists. I will not insist on that. And then we are ready to refer to Pareto efficiency and an economic allocation involving the decisions of all the agents. Is Pareto efficient if there does not exist a feasible alternative which is preferred or indifferent for everybody and preferred for at least one person? First welfare theorem, every competitive equilibrium is Pareto efficient. And this, of course, has been a theme on which people like Friedman yesterday, but maybe some of his followers today, spend their lifetime. Second welfare theorem, given a Pareto efficient allocation, there exists a competitive equilibrium which is precisely the same as this Pareto efficient allocation. It may not be a competitive equilibrium as such because it would take transfers of initial resources to sustain this alternative Pareto efficient allocation, but that can always be done. And indeed, if you look at these two theorems, you can understand that some people are so fascinated by competitive equilibria. Many people are fascinated by beautiful stars, even if they have no chance ever to meet them. Now, the second theorem has a very important implication, namely that if markets are incomplete, and we talk about constrained Pareto efficiency, it will typically be impossible to attain a first best. And then, of course, we want to be reminded of the theorem of the second best, Lipset-Lancaster. The general theorem of the second best optimum states that if there is introduced into a general equilibrium system a constraint which prevents the attainment of one of the Parisian conditions, an example of such constraint would be incomplete markets, no full trading, then the other Parisian conditions, although still attainable, may no longer be desirable. This is a very important theorem. The implication for my interest today in analyzing models with incomplete markets is that we know that first best optima in the sense of the general equilibrium theory are not attainable. Now, whatever we do to state useful properties, desirable properties, is part of second best theory, and we must accept that other conditions that are standard in the first best analysis will not be maintained, either because that's not possible or because that is not desirable. And there will be ample illustration of this in what follows. Now, given the fact that the complete markets model is unrealistic, there have been developments of more specialized model. One development is called GEI, General Equilibrium with Incomplete Markets. I forgot to come to the next page. Yes, General Equilibrium with Incomplete Markets. Now that makes a very strong and again unrealistic assumption about the knowledge of the future of the economic agents. It is there assumed that all agents hold common, correct, single-valued expectations about future prices. Certainly, my expectations are not single-valued for any of the issues of interest that I face, and whether they are correct, well, one learns, but certainly they are not bound to be correct. So this is a minor extension of the unrealistic general model. Again, it is of interest, theoretical for normative analysis, but with little empirical relevance. The empirically meaningful model is called temporary general equilibrium, which is concerned with the first two time periods in the tree, today and tomorrow, with markets today and expectations about tomorrow, which are allowed to be idiosyncratic, vary from individual to individual, allowed to be multi-valued. You don't have point expectations about most prices. And correct, if they are multi-valued, is less sharply defined, but no specific assumption in that direction is made. So we shall be concerned with a temporary general equilibrium analysis, retaining the basic model that has been outlined, but not all the assumptions. And to begin with, let us look at the assumptions about household preferences. Three assumptions are standard: completeness, convexity, continuity. Many of you must have heard me say the consumer is a triple con. And these assumptions will be generalized to eliminate the completeness. And fortunately, there exists weakening of the convexity and continuity assumptions that are compatible with incomplete preferences, but that prove strong enough to do the existence theory in general equilibrium. These two assumptions, weak convexity does not assume that the preferred set are convex, but simply that if we talk about the set of allocations preferred to X, X itself does not belong to the convex hull. That is, if two alternatives are both preferred to X, there is no convex combination which is X itself. That follows under convexity and remains well defined for incomplete preferences. And weak continuity, instead of assuming that the preferred or indifferent sets are closed, one makes an assumption of open graph, which means that if you have an element in the preferred set, there is a vicinity which is compatible with the same preference. These two assumptions, did I say already, were introduced by Schaefer and Sonnenschein in a paper which dates back some time. So, we are now ready to start with the three areas I wanted to discuss with you, and start with insurance. To deal with insurance, I will assume that the agents are weakly risk averse. The reason being that today there are ample opportunities to buy uncertain prospects on fair or better than fair terms. We even had a colleague here in Louvain-la-Neuve working in computer science who resigned to spend his whole time taking advantage of betting on safe, more than fair terms. Now, an insurance policy viewed by someone like DREZE, by the general equilibrium theorist, is essentially one remedy to the difficulty of working with complete markets by writing down a contract that pools a number of risks in a single policy. Example, house insurance. There are many conceivable forms of fire damage in a house. The DREZE model would say, but there are markets where you can trade contingently on any of them, and that, of course, would be hopeless. The insurance policy pools them all. And it will offer insurance for the purpose of the Arrow theorem, which goes back to 1963. The model is somewhat specialized. 2 periods, S possible states tomorrow, of given probabilities. Arrow's theorem assumes that the probabilities are known to both parties. He's only concerned about aggregate resources, a single commodity wealth, and then he looks at an agent age whose endowment is subject to risk. that was going too far. The endowment omega H is reduced by a risk ZHS, which is state dependent. And then the insurance policy will stipulate what fraction of the risk is borne by the insurance company. Again, think about fire insurance for a house. ZHS would be the cost of repairing or rebuilding after some kind of fire, and the insurance policy stipulates for each potential occurrence what fraction of the cost is covered by the company. But there is a loading factor. Insurance companies do not charge premia equal to the expected value. Of course, they have to cover their own costs. The extent of this loading factor is often surprising. The first time I looked at data, it was after Edmond Malinvaud had presented a paper in which insurance played an important role, and the first data I looked at displayed a loading factor equal to 1. The premium was twice the actuarial value of the risk. Now, I do not present that as the general case, but my impression is that 1/3 is probably a model estimate of what loading factors are for a variety of policies, and the interval 1/4 to 1/2 would contain many of them. Now, Arrow assumes that the agent have state-dependent preferences representable by their expected utility. Since then, there has been a lot of work to extend Arrow's theorem, possibly slightly modified, to much weaker assumptions. If you want to talk to an expert in this field, I think that Christian Gaulier, who is sitting here, would qualify, and if there are other experts, he will know them. All right, so what does Arrow's theorem say? An optimal policy, under the assumptions we have made, 2 periods, expected utility, etc., calls for the choice of a deductible delta, en français une franchise delta, entailing a corresponding premium, and such that the share of the risk borne by the individual is he pays or she pays the premium, and then when the risk materializes, the insured person's share never exceeds delta. So you have full insurance above the deductible, self-insurance below the deductible, and a premium which is adjusted downward, all the more so that the deductible is higher, in line with the loading factor. Is this clear for everybody? I would like to ask who is currently insured in a policy with a deductible. Not too bad, age bias. For me, the deductible theorem, Arrow, is the most useful practically useful paper I ever read. In 1968, we were buying our first house and wanted to insure it against fire and related accidents. And I had a core discussion paper written by Jan Mossin from Bergen, who derived conditions for optimal choice of the value for the house to be insured as a function of the loading factor. But to choose that amount, you had to make forecasts of future wealth and all kinds of things. I just couldn't do it. And then somebody gave me Arrow's paper, or I found it in the Journal of Economic Literature. I don't remember, but there was the solution. Insure with a deductible. Now that I could do, well, I thought, because when I called my broker, he could not find an insurance company willing to offer me a policy with a free choice of deductible. And I took the deductible by insuring the furniture below value and assuming that in most reasonably severe cases of fire, the furniture would also suffer, and I had found my deductible. So this is a very helpful theorem. Interestingly, the proof is just a few lines. I don't invite you to read it. I want to discuss with you the applications of this theorem. And there one is surprised. As I said a minute ago, not all insurance companies are willing to offer policies with the choice of a deductible. I have seen a number of empirical papers reporting the deductibles that people choose, and they are almost invariably minimal. People will not pay 50 euros a year to raise the deductible on their automobile Omnium policy from 500 to 1,000. I have ceased to be surprised with this. Why? Because in 1980, I wrote a paper linking the choice of deductibles to the loading factor and the risk aversion of the buyer. And you can write a first-order conditions that involves these three elements. And then you can find out for given loading factors and given risk aversion what the deductible should be. And I showed this paper to a friend of mine in Stanford. Very competent, very able person, especially in the field of deductibles. And he looked at a table with the result, and he said, no, that cannot be true. There is a mistake, I'll bet. So I gave him the paper, and on the spot he studied. And then he took a little pocket book, made an entry while telling me I must call my broker to increase my deductible substantially. So after that experience, I am not surprised that many people choose a deductible that is too low. And this leads me to my first challenges. Teaching challenge, teaching in the broad sense, not university teaching. Present a sample of house insurance subscribers with Arrow's theorem. then with a potential set of alternative deductibles for a policy of their own, discuss with them the choice of an optimal deductible as a function of the loading factor. I'll make several suggestions this afternoon that go in the direction of familiarizing the economic agents better with more or less technical aspects of economics of uncertainty and incomplete markets. I think it would be interesting to check empirically what is understandable and what may not be, and how people think about this issue. The second challenge is not teaching but policy. The last paper I read on choice of deductibles by US households, it's a paper in Quantitative Economics, a journal of the Econometric Society, by 3 authors with impossible names. And they obtained from an insurance company data on the choice of deductibles by clients who held 3 insurance policies: a responsibility for automobile, an omnium for automobile and house. And he tries to interpret these results. Nowhere in that paper, endorsed by the Econometric Society, nowhere is it mentioned that if you have 3 policies, you should analyze the deductibles globally. You should try to integrate the 3 policies with a single deductible. Otherwise, you don't really have a deductible, because you may face several diseases simultaneously or consecutively and have the deductibles add up. So this issue has been faced in the literature. Not that much, says Christian. But it's an interesting issue, and I say policy challenge. Promote a scheme of global insurance where a given agent will pool all his policies with a common deductible. That would definitely be an improvement, and it should not be difficult. I'm surprised that insurance companies do not on their own offer this advantage to their clients. I think an insurance company that would today put on the market an integrated policy with a single deductible would have some market. Now, I cannot claim how large this market would be, but if I were a director of an insurance company, I would certainly ask that this be studied more carefully. There is more to say about Arrow's theorem, but I will limit myself to an interesting aspect: choice of an income tax schedule. I see my president, Philippe Chevalier, sitting there in the middle. Suppose that the Belgian finance minister comes to Philippe and tells him, I have great respect for all you do. I know you can even do more. I think that your future contains a number of bright possibilities, of which, of course, I will get my share through the income tax. Now, as you know, the income tax is progressive, and maybe you would prefer a different schedule. If you wish to have your own schedule with an expected value of taxes paid at least equal to my estimate, we could accommodate you. You have never been asked that, Philip. No, of course. Now, how would one approach the problem? How to choose your own income tax schedule if you have an uncertain future income? Well, formally, this problem is the same as Arrow's insurance problem. So the deductible theorem applies. And what would that say? It would say there will be a certain level below which I pay no taxes and above which I pay 100% on the supplement relative to the deductible. That means that individuals who could choose their income tax schedule on the condition of a given expected value should, according to Arrow, choose 0 up to a critical level, marginally 100% from then on. Sort of Merle's on his head. Of course, the finance minister would say, yes, but if he pays 100% marginal tax, what about his incentive to work? And of course, everything that has been said so far about insurance must be expanded to take into account issues of moral hazard and adverse selection, which are well-known problems in insurance. But we will come back to this. Let me refer to this as the Arrow-Chevalier income tax schedule. All right. I still have a little time. I turn now to the second theme, which I introduced as reinsurance, the theorem of Karl Borg. Extremely interesting and important theorem. Again, it's a simplified model, 2-period estates tomorrow of given probabilities, a single commodity, but now several agents with state-dependent endowments the same as in the previous case, and expected utilities. No further constraints beyond physical feasibility. You may choose an allocation of resources for these agents, let's say capital H, total number, and you would like to characterize Pareto efficiency, that is, characterize allocations that maximize a weighted sum of expected utilities with weights lambdas no longer loading factor. Pareto weight of an individual agent in the statement of the problem. So Borg studied that problem in 1960. His interest was reinsurance, the different agents being insurance companies, reinsurance being a pooling of the risks of the different company into a broader. So mutuality principle a necessary condition for Pareto efficiency is that the consumption of each agent depends upon the state of nature only through the aggregate dwells in that state. In other words, Pareto efficiency calls for pooling, 100% pooling all the risks and then sharing the total. Clear enough? Transparent, not necessarily well known. This theorem is not universally known? Not really, okay. So, and the proof this time is one line. It's a concise statement of the proof, but it's immediate. So that's a necessary condition. And then there is a second principle called sensitivity. A Pareto efficient allocation is such that the marginal rate of substitution between any two states of the world is the same for all agents. That is, if you want to transfer resources from a no-accident state to a state with a major accident, there is for each agent H a marginal rate of substitution between resources in the two cases. These marginal rates should be the same for all agents at a Pareto efficient allocation, which is equivalent to the complete market's property. The complete market's property says at a comparative equilibrium, the marginal rate of substitution between any two goods is the same for all agents unless there are constraints, but here it was clearly stated no other constraint. So, I could go into a discussion of that in terms of risk tolerance, but I don't have that much time. If we want to think about the mutuality principle, it must concern all the agents, for each agent all the resources, and that means it must include intergenerational analysis and international analysis. So that looks like asking a lot. There are really no known cases of risk pooling involving all the citizens of the world, present and future. But fortunately, this principle can be applied in stages. The clearest illustration is that of a federal state like the US, where a number of risks call for reallocation between states, leaving it to the states to translate the reallocation among the citizens. I have written an e-book for Rebel on applying this to the regions of Belgium. Currently, there is a lot of redistribution resulting from situations of the citizens. And in a region where people are on average richer, the federal entities collect income taxes which are higher per capita than in regions where the citizens are poorer. And then you have a phenomenon of unequal contributions per capita to the federal budget, which some people confuse for transfers between regions, whereas they are transfers between individuals. So that is an application of the two-level I have to hurry up. So if we look at the application of the mutuality principle, we first have the individual level. This calls for an income tax scheme that combines all sources of income of a taxpayer over his or her lifetime. And I will devote the rest of this first lecture to cumulative averaging, which is the way to do that. Mutuality principle at the firm level, certainly the workers and the capital owners should mutualize in some way, and I'll say more about that tomorrow. I talked about federal nations. Finally, for a set of nations like the EMU members, there is scope for organizing a mutualization of idiosyncratic risks to national incomes. And I'll talk about that tomorrow, not today. But today I will conclude with a discussion of cumulative averaging. May I ask, for whom is this a familiar term? Not many at all. For me, it became familiar early because cumulative averaging was introduced in an article of my teacher, William Vickrey, in 1939. But being close to Vickrey, we learned about cumulative averaging. So we start from the mutuality principle, which says you should mutualize the global income of each household. Global meaning income from all sources, in particular combining labor incomes and capital incomes. Some people say that is the tax shift, but if you look at the tax shift of the current government in Belgium, it's very different and does not have the ambition of pooling the capital and labor incomes. And then you want to combine over time if you want the global income of a taxpayer. And that is exactly what Vickrey suggested in 1939. How do you do that? Well, let the finance department keep a record of all the assets owned by a taxpayer. So like in France, you now would have to declare to the fiscal authority what you possess, including real estate, stocks, bonds, shares, small firms, all the capital. And these assets will be valued annually. Now, for some of them, it is very easy because there is a market value. If you have shares of IBA, there is a market value. real estate, your own house where you live. Well, in the Netherlands, the value of the house is updated annually on the basis of observations of transactions area by area. Shares of small firms is more difficult, and of course the only person who can suggest a value is the owner. Well, you accept that the annual amounts may be revised automatically later on at no loss of performance. So, on this basis, for each taxpayer, you assess each year the total income, labor income as we are used to, plus capital income. In some cases, the fact that you combine is a simplification, like a privately owned firm where the owner works. Here you don't need to dissociate the labor revenue from the capital revenue. I don't go into details of how you treat acquisitions and of the interest accounting of the scheme. But having defined global annual income, you then proceed to averaging. Second paragraph, the annual incomes recorded since the beginning of the taxpayer's fiscal history. You go back to the first year where this person was liable to income tax. You have for each year a global annual income. You compute the average. And you compute the tax holding for the average. In Vickray's work, the tax rates were constant over time. I'll come back to this in a minute. So you compute the average income over the fiscal history, the income tax corresponding to the average, and T times that income tax is the total tax due over the fiscal history. Then you look at what has been paid before. You compare that. What has been paid before was the same computation for T minus 1 years last time. Now you update, you do it for T, and you collect the difference between the total tax due for T years on the basis of the average income, whatever has been paid before, both cases interest accounted, and you pay the difference or you collect it. Is this reasonably clear? Clarification question?
Yes, I do not see how you tax the people who spend their whole income, because it's the tax on the hands and the
Can you repeat, speaking very loudly?
I do not see the tax base of the people who spend their whole earnings and do not accumulate wealth. So that's only a tax on wealth and not on income.
Well, this is a tax on income, either labor income or capital income. It is not a tax on wealth. There is no penalty on spending your wealth, except, of course, that it does not generate additional capital income.
No, but if you earn labor income and spend it, you have no increase and no tax base.
Well, it means that your capital income is zero. That's all. You can live on your labor income year after year, never save and accumulate, and you then have zero capital and zero capital income year after year. Simplifies the calculations, that's all. Okay? Good. All right. So this is cumulative averaging taxation. And Vickrey's motivation was to obtain income taxes with a progressivity independent of the timing of receipts. If you have a stable income, you pay a certain tax. If you have a variable income averaging to the previous level, you will pay more tax because of the progressivity, but not under Vickrey's scheme. It can be very important. We are told that a Belgian finance minister advised a young tennis player who was a star earning millions. The finance minister of Belgium advised her to take residence in Monaco and not pay Belgian income taxes, because she had to live for many years when she would no longer have this high income from her savings. And it was inappropriate that this person with a lifetime average income be taxed on most of her earnings at top rates. Okay, you understand this? There have been some applications of cumulative averaging, in particular in Canada, but currently there are hardly any, and maybe there should. But before answering that question, I note that Vickrey's analysis assumed constant tax schedule. But in practice, there are fluctuations in the expenses and revenues of the state. We know that in Belgium nowadays, occasionally we read in the paper or hear on the radio the figure of what must be raised within 18 months or whatnot. So the logic of cumulative averaging would say when we compute the tax on the average income of a certain fiscal period, we should take into account that the tax rates applicable to this amount may have changed and use the average rate over the period. Now, this would leave the authorities free to decide when and how they would like to change the tax rates. And we will talk a lot about that tomorrow. Before then, I conclude with two challenges. implement cumulative averaging of the current income tax system. I did not mention, of course, I should have, an important point. If you want to tax capital incomes, there you know that the timing may be very irregular, if only due to the timing of the sales of owned assets. And cumulative averaging is crucial if you want to implement annual taxation of capital gains together with labor. And that would be one of my motivations. I think applying cumulative averaging of our current system of income tax would be a step forward. For the incomes which are currently taxed, it is not very difficult to implement. DREZE has written many pages on the theme cumulative averaging simplifies the tax legislation. Not simple to read, these comments. But so that is one reason why one might wish to implement cumulative averaging today. And the other reason, of course, is that one would be making one step to prepare for the day when one might hopefully be able to tax capital gains on par with labor income. Now, this requires honest reporting of household wealth. And you heard about the Bahamas today? Yes. The question of a genuine tax shift that pools capital and labor income rests on the possibility of keeping record of people's wealth. How could we implement that? And that is the question with which I will leave you at the end of this first lecture. I did not mention the challenge of finding ways of promoting honest reporting as a policy challenge. We don't know how to do it. As a research challenge, who is ready to start really working on that? There is some creativity needed in finding the right ways to approach this problem, and that is a deeper challenge than policy or research. So much for the first lecture.